Let's be honest, 2025 has been a brutal roller coaster for investors. While most people watch their portfolios get absolutely crushed by the violent swings, a handful of investors didn't just survive, they thrived. What did they know that you don't? It wasn't luck. They had a playbook for this new era of volatility, and today I'm giving you that exact playbook. We'll cover strategies for both conservative and aggressive investors so you can turn this market chaos into your biggest opportunity. For years, the rules of investing seemed simple. Buy good companies, hold on tight, and let the market do its thing. Well, 2025 shattered that illusion. The whiplash moves we saw, driven by sudden policy shifts and sector tremors, left countless investors confused and frankly, a lot poorer. Yeah, they followed the old rules and got punished for it. But the investors who came out on top weren't just lucky, they were prepared. They understood the market had changed and they adapted. They had a plan for the chaos. Today, you get that plan. We're going to break down what happened in 2025, why the old ways failed, and then I'll give you two clear, actionable playbooks. First, the Fortress Portfolio for conservative investors who want to protect their capital. Second, the Opportunistic Growth Engine for aggressive investors who want to use this volatility to their advantage. By the end of this, you'll have a framework to navigate not just the rest of this year, but the new age of investing we've clearly entered. To know where we're going, we have to understand what just happened. We started 2025 feeling cautiously optimistic. After 2 strong years, Wall Street was bullish, and the consensus was that the market would keep climbing. That optimism got dismantled fast. The core problem was that old strategies like buy the dip suddenly became a recipe for catching a falling knife. Even the classic 60-40 portfolio, 60% stocks, 40% bonds, failed to provide a cushion as both sides came under pressure. The first big blow came early in the year. The new U.S. administration announced aggressive new tariff policies, sending shockwaves through global markets. Uncertainty exploded. The market's reaction wasn't a slow bleed, it was a violent repricing of risk. The S&P 500 plunged, dropping a sharp 10.1% by mid-March. The VYX, the market's fear gauge, spiked to the highest levels since the 2020 stock market crash, showing just how anxious investors were. This wasn't just a number on a screen, it was a gut punch to millions of people. The pain was amplified by sticky inflation concerns. The Federal Reserve, which had been cutting rates, was now in a tough spot. Could they keep cutting if inflation was heating up again? This uncertainty hit the bond market, the supposedly safe part of a portfolio, and bond prices struggled. So in just a few weeks, investors were getting hit from all sides. Stocks were down double digits, and their bonds offered little protection. And this is where the real carnage happened. Investors who were unprepared, reacting to scary headlines, made the biggest mistake. They sold near the bottom, turning a temporary paper loss into a permanent one. And then, just as fast as the storm rolled in, the skies cleared. By April, the administration paused some of the harshest tariff measures. The market, which had priced in the worst-case scenario, exploded higher. We saw a historic rally, and those who had panic sold were left on the sidelines, watching in disbelief as the market roared back to new all-time highs by the middle of the year. Missing just those few best days was the difference between a big loss and a positive return. I'll be the first to admit I saw my own portfolio take a hit in that March drawdown. It's never fun to see that much red, but because I had a playbook, I knew what to do, and more importantly, what not to do. I didn't sell my core holdings. My plan told me it was time to selectively add to great companies that were suddenly on sale. The data from 2025 is clear. The market punished emotion and rewarded discipline. This whiplash environment is why a new playbook is no longer just a nice to have, it's a necessity. It would be nice to think of early 2025 as a one-off freak storm, but that would be a dangerously naive assumption. What happened this year wasn't an anomaly. It was the start of a new market reality. The rules for investors have changed. So what are these new rules? First, markets are driven by policy. For better or worse, a government press conference or a central bank announcement can now move markets more than a quarterly earnings report. We saw it with the tariff news. The market didn't plunge because corporate profits vanished overnight. It plunged because of a policy announcement. The rally wasn't because of an economic miracle. It was because of a perceived shift in that policy. This means your portfolio is constantly exposed to headline risk from Washington, D.C. and other world capitals. Second, the market is concentrated and leadership rotates quickly. For a while now, a handful of mega cap tech stocks, mostly tied to the AI boom, have been doing all the heavy lifting for the S&P 500's gains. This is a double-edged sword. When they're hot, the market soars. But when they stumble, it can feel like the whole world is falling apart. And as 2025 has shown, leadership can broaden. While AI and tech led the recovery, other sectors like financials and industrials started showing real strength by mid-year. If you were only looking at tech, you missed out. Third, we have sticky inflation and a less predictable Fed. The fight against inflation has made the Federal Reserve's job much harder. While rate cuts continued through 2025, policymakers are walking a tightrope trying to support the economy without letting inflation get out of control. This creates a minefield for both stocks and bonds. The 10-year Treasury yield, a key global benchmark, has been volatile, recently hovering in the 3.70% to 3.75% range as the market tries to guess the Fed's next move. This means the safe part of your portfolio isn't so simple anymore. What this all adds up to is this: the passive set it and forget it strategy is carrying more risk than ever. If your plan is just to buy an S&P 500 index fund and hope for the best, you've strapped yourself into a roller coaster and handed the controls to politicians and market sentiment. To win now, you need to be proactive. You need a framework that expects volatility and tells you what to do when it arrives. You need a playbook. This first playbook is for the investor whose main goal isn't to shoot the lights out, but to make sure the lights stay on. You're focused on protecting your money, generating steady income, and sleeping well at night. Your mantra isn't about hitting home runs, it's about avoiding strikeouts. In this new era, a fortress portfolio is about building a multi-layered defense. The challenge for conservative investors in 2025 was that their safe assets acted weird, bonds were volatile, cash felt like it was losing value to inflation, and even safe blue-chip dividend stocks got hit in the March drawdown. So how do you build a fortress when the old building materials seem shaky? You upgrade your materials. This playbook has 4 essential plays. Play 1, your foundation must be rock-solid defensive stocks. First, you have to be deliberate about the type of stocks you own. The fortress portfolio is overweight in defensive sectors, businesses that people use no matter what. I'm talking about utilities, consumer staples, and healthcare. Think about it. When people are panicking about tariffs, they don't stop brushing their teeth, turning on the lights, or going to the doctor. Demand for toothpaste and electricity is pretty stable. This gives these companies predictable revenue that other businesses envy. During the 2025 sell-off, while flashy tech stocks got hammered, these sectors held up much better. They might not give you all the upside in a crazy bull run, but their job is to protect your downside, and that role was priceless this year. Play 2, the modern way to do bonds, the ladder. Second, let's solve the bond problem. Just buying a long-term bond fund was a bad move in 2025. A better strategy is a bond ladder. It's a simple but powerful idea. Instead of putting all your money into one bond, you spread it across multiple bonds with different maturity dates. Say one that matures in 1 year, another in 2 years, 3 years, and so on. Here's why it's so effective. It manages your interest rate risk. If rates go up, you're not stuck with a low yield for a decade. As each rung of your ladder matures, you reinvest that money at the new higher rates. If rates go down, you've already locked in higher yields on your longer-term bonds. A ladder gives you predictability and flexibility, turning you from a victim of interest rates into an active manager of your own income. Play 3, focus on the right kind of dividends. Third is a focus on income through dividends, but with a huge catch. Don't just chase the highest yield. That's often a trap. You want to invest in dividend growth stocks. These are top-tier companies with a long history of not just paying a dividend, but increasing it every single year. A track record of dividend growth is a huge sign of a company's financial health. A company that can raise its dividend through recessions and market crashes is showing you it's a durable, cash-flowing machine. We're talking about the dividend aristocrats, S&P 500 companies that have raised their dividends for over 25 years straight. The benefit is twofold. You get a reliable, growing income stream, and these stocks tend to be less volatile. Play 4. Cash isn't trash, it's your secret weapon. Now, the final play is to rethink the role of cash. For years, we were told cash is trash because it loses to inflation. That's only half true. In this new era, cash is a strategic asset. It's your opportunity fund. Holding a strategic amount of cash, maybe 10% of your portfolio, does two things. First, it's a psychological buffer. It gives you liquidity so you never become a forced seller during a downturn. You never have to sell your best assets at the worst possible time. Second, it gives you the dry powder to go on offense when others are running for the exits. When the market went on sale in March, your cash reserve was what allowed you to buy more of those high-quality stocks we just talked about at a discount. Without cash, you're just a spectator. With cash, you're a predator. It turns you from a victim of volatility into a beneficiary. Putting it together, the Fortress portfolio allocation. So, what does this look like? Here's a blueprint, not personalized advice, that you should adapt to your own situation. 50% in bonds, mainly in a ladder of high-quality government and corporate bonds. 30% in defensive equities, stocks or ETFs focused on utilities, consumer staples, and healthcare. 10% in dividend growth stocks, companies with a long history of increasing their dividends. 10% in cash or short-term treasuries, your strategic opportunity fund. This allocation is built for resilience. It's designed to withstand shocks, generate income, and give you the power to act. It may not catch every last bit of a bull run, but in a year like 2025, it's the key to preserving your capital and your peace of mind. If you're finding this useful, I have a free newsletter where I share my latest market breakdowns before they ever become a video. The link is in the description. All right, for those of you with a higher risk appetite, let's talk about how to play offense. This is where it gets fun. This playbook is for a different kind of investor. You understand and accept higher risk for higher returns. You have a long time horizon and a strong stomach. You see a market drop not as a crisis, but as a sale, a chance to grab innovative companies at a discount. Your goal isn't just to survive, it's to aggressively compound your wealth. For you, volatility is the engine. The challenge for aggressive investors in 2025 was a paradox. The biggest growth areas like AI and tech were also the most expensive and volatile. Valuations were high, which meant any hiccup led to a painful correction, which is exactly what happened. Timing the V-shaped recovery in April was nearly impossible. If you weren't already in, you missed it. So how do you play offense in a market like this? With a mix of focused conviction, flexibility, and some more advanced tools. This playbook also has 4 key plays. Play 1, lean into the epicenter of innovation, AI and tech leaders. First, you lean into the volatility. This means a core strategic allocation to the main driver of modern growth, technology, specifically the leaders of the AI revolution. Yes, these stocks got crushed in the sell-off, but they were also the very first to rebound and lead the market to new highs. The strategy here isn't to just buy a generic tech fund. It's to concentrate your capital in the dominant best-of-breed companies building the future. Think of the picks and shovels of the AI gold rush, the semiconductor designers, the cloud platforms, and the software companies integrating AI. Their strategic position is so strong that short-term price swings are often just noise around a long-term growth story. For an aggressive investor, the March dip wasn't a reason to sell. It was the exact buying opportunity you were waiting for. Play 2. Use volatility as an asset. Sector rotation. Second, be nimble. While a core in tech leaders is key, the aggressive investor knows that leadership rotates. As we saw in 2025, after the initial tech rebound, other sectors like financials and industrials started picking up steam as the economic outlook improved. The Opportunistic Growth Engine uses sector-specific ETFs to ride these waves. This is a more active strategy. It means you're not day trading, but you are making deliberate adjustments to your satellite holdings every few months based on where the strength is, all while keeping your core tech positions. Dollar cost averaging into these tactical positions is a smart way to do this, since it stops you from trying to perfectly time the tops and bottoms. Play 3. Expand your horizons, international and alternatives. Third, look for growth beyond the obvious places. U.S. tech has been the world leader for years, but that's not guaranteed forever. The aggressive investor knows that some of the best growth stories of the next decade might come from emerging markets. A strategic allocation, maybe 15% to international and emerging market funds, gives you crucial geographic diversification. For the truly aggressive, we can go a step further with alternatives like venture capital or private equity funds that invest in the next generation of innovators long before they hit the stock market. These are long-term, high-risk investments, but they offer the potential for exponential returns you just can't find in public markets. Play 4, advanced tactics, the option play, cash-secured puts. Okay, this is the most advanced play. Disclaimer, this is an advanced strategy and is absolutely not for beginners. If you don't have a deep understanding of options, you should skip this entirely or do a ton of research first. This isn't a recommendation, it's an explanation of a tool sophisticated investors use. The strategy is selling cash-secured puts. In simple terms, you get paid cash, a premium, to agree to buy a stock you like at a lower price, the strike price, if it drops by a certain date. You have to set aside the cash to actually buy it if that happens. Here's how it becomes so powerful in a volatile market. Let's say there's a great tech company you want to own, but you think its price is a bit high. You can sell a cash secured put with a strike price 10% below where it's trading now. Two things can happen. If the stock stays up, the option expires, and you just keep the cash premium you were paid, free income. If the market has a sharp drop like we saw in March and the stock falls below your strike, you're forced to buy it. But that's a win. You just bought a world-class company you already wanted at a 10% discount, and you got paid for your patience. It's a strategy that lets you get paid to wait for a sale. Putting it together, the opportunistic growth allocation. So what's the blueprint here? Again, this is a framework, not a one-size-fits-all prescription. 50% in growth stocks, a concentrated portfolio of leaders in AI, tech, and biotech, 20% in sector ETFs, tactical positions in sectors showing relative strength, 15% in international EM growth for geographic diversification, 15% in alternatives and high yield, a mix of higher risk assets for explosive long-term growth potential. This portfolio is not for the faint of heart. It requires active management and a strong stomach. But for the right investor, this is the playbook that doesn't just weather the storm, it harnesses its power. I've just laid out 2 detailed playbooks, but none of it matters if you make the single biggest mistake that destroyed more wealth in 2025 than anything else, making emotional decisions. This isn't some fuzzy concept. It's a real portfolio destroying force that shows up in 2 ways: panic selling and FOMO chasing. Think back to the 2025 roller coaster. The market plunges in March. The headlines are terrifying. The emotional investor with no plan sees their account balance dropping and makes the gut decision to stop the bleeding. They sell. They lock in their losses. Then weeks later, the market stages that ferocious V-shaped recovery. The same investor is now watching from the sidelines, paralyzed by a new emotion, fear of missing out. FOMO. They can't stand missing the rebound, so they buy back in, often at a higher price than where they sold. They just successfully executed the perfect wealth-destroying maneuver: sell low, buy high. This cycle is kryptonite for investors. The antidote is simple to say, but hard to do. Have a written plan before the chaos hits. Your portfolio's worst enemy is you, staring at the screen during a 500-point drop with no idea what to do. These playbooks are that plan. They are your pre-made decisions that protect you from your own worst instincts. 2025 was a wake-up call. It taught us that volatility isn't a bug, it's a permanent feature of the market now. Success is no longer about just buying and hoping. It's about having a deliberate strategy that fits your goals and your stomach for risk. We've covered two clear paths: the fortress portfolio to preserve capital and generate income, and the opportunistic growth engine to harness volatility for outsized growth. The key is this: you must choose your game and know the rules. The worst thing you can do is stand in the middle of the field, reacting to every single play. Remember, time in the market, guided by a solid playbook, is infinitely more powerful than timing the market. Now you have the plays. It's time to run them. If you got value from this breakdown, do me a huge favor and hit that subscribe button. And let me know in the comments which playbook you lean towards, the Fortress or the Opportunist. Thanks for watching.